Hello friends, Namaste. Welcome all of you to my channel. Today let's discuss about how do we analyze the receivable part. And we know that friends, the market is so competitive and we have to sell the goods and services under credit. But it doesn't mean that we sell the goods haphazardly. We have to analyze the customers. We should know our customer too. But however, there would be some customer, there might be the default, right? Then that would be the case of uncollectible account, and today discussion would be more about the simply how we could understand the term receivable and how we could analyze the receivable part. Now let's see that we have a one seller name is called Lakhan, and next one is that Madan. Lakhan is from, let's see, from Ludhiana, right? And Madan is from Himachal Pradesh. Okay. Then in this case, simply seller sell the goods to the Madan here for $10,000, right? And so that would be the receivable to the that is the Lakhan, and for the Madan that is called the payable, right? That is the purchase goods under credit. Now the question is about how we record the journal entry in the book of Lakhan, yeah, seller. Then simply we say that account receivable, name of the customer, that is the Madan, right? Then to sales revenue 10,000. Now if we say that if Madan become insolvent and only 2,000 could be realized from him, then how we record the journal entry? Since amount of realized by seller here from Madan, that is the just 2,000, so cash account debit. Bad debt expenses debit, since already Madan became insolvent, so you know that, yeah, that amount would not be recovered, so you say that bad debt expenses account debit to AR Madan account, so that this amount would be debited in the PL account. Now when you record the closing entry, friends, that is the simply we say that profit and loss account debit to bad debt expenses account, right? Now at the same time, sometime there might be the case Madan reached to seller and say that because of some financial problem I could not pay on the time. The amount that seller already written off here, that is a bad debt, right? So in this case, what we do here, that is the cash account debit to bad debt recovered account. That is the case of bad debt recovery. Okay. So bad debt recovery in PL account, we just credit it, and your closing entry would be bad debt recovery account debit to profit and loss account. So in PL account, it would be credited. Now next move to the uncollectible accounts. Now issue is that how diligently the credit department or the seller investigates their customer. There might be the case where the customer would default. That means they would not pay the dues on time because of some unexpected problems or slowdown in economic condition. For example, like if you remember, like a COVID pandemic situation, so many business houses collapse. Yeah, we can say that become the insolvent. Yeah, unexpected slowdown in economy, and that causes default, right? Customer default. So anyway, when we have a credit risk, that means when you are selling the goods or services on a credit, you will be dealing with the bad debts. That term is known as uncollectible account. So we have a two approach of estimating the bad debt. One is called percentage of sales approach, under which we say that certain percentage of the sales would be uncollectible. Okay. Then this is all about, let's see, if we assume that 10% of the credit sales, as we discussed in the slide number 2, that is the 10,000, then we say that that would be uncollectible. That means 10% of $10,000 would be 1,000. So you would record the adjusting entry like this: bad debt expenses account debit to allowances or provision for doubtful account, friends. Okay. Now next one is that next approach is called percentage of receivable approach, under which what we do, we take into account of receivable amount over the period, and which needs to be multiplied with the estimated percentage of uncollectible account, and then whatever the credit balance or debit balance of doubtful account given in the questions, that would be considered. Now you might have question about what do we understand by the term the credit balance here. The credit balance is the case if we say that here seller simply overestimate the probable bad debt, then in that case we would have a credit balance. But at the same time, when the seller underestimate the probable bad debt, we would have a debit balance. Okay. Now look at these questions, and this is all about you are given the simply the age of receivable, aging of receivable, which is also known as day sales outstanding, and this is the receivable amount, and we have estimated uncollectible account or the bad debt. Then next one is that you would be just calculating like this: 1.5% of 10,000, then 4% of 4,000, 20% of 2100, and 40% of 1000. So similarly we came to know that $1,130 is our ending balance of our doubtful accounts, right? But in this case you are given the credit balance of doubtful accounts. Okay, and credit balance you would have because of your overestimation of bad debt, right? Now when we like to do the working note in the like T accounts, we have a credit balance of 150, ending balance is 1130. So this gap is known as your bad debt expenses, friends. This is the estimated bad debt, that is the 980. So you would have a journal entry of simply uncollectible account expenses or bad debt expenses to allowances for doubtful account, that is the 980, right? And you accordingly you could mention your narration too. Now the question is about how we analyze the receivable part. Then you have to use the two ratios here. One is called receivable turnover ratio. This is simply the ratio of net credit sales to average receivable, that is opening plus closing receivable divided by 2, which measures the liquidity of the receivable one. And next one is that it measures the number of times on average the company collect the receivable during the period. Then when you are approaching to the bank for working capital loan, then they will be looking after your receivable capacity too. Receivable turnover ratio. Higher the receivable means your liquidity of the receivable is good, right? And next one is that average collection period. That means how fast we collect our receivable, which assess our effectiveness of the credit policy or collection policy. So collection, note that collection period should not exceed the credit term period. Suppose you have here Lakan sold the goods to Madan, right, for 90 days. That means above 90 days, that is the credit period is that 90 days, right? Beyond 90 days, the credit term cannot be decided, right? So you have to be very clear about your analysis of your credit policy, everything. Then probably you could better evaluate your receivable, and that could be the good situation for your company. Yeah, we see that at the like your individual level too, at the corporate level, at the government level too. That's the receivable analysis is very important, friends. Okay, friends, these are the things that I would like to share today. I hope that whatever I discussed today is the concept of receivable, analysis of receivable, estimation of uncollectible account, that would enrich your understanding level, friends. If you have any question, please let me know and also provide your comment. Thank you all of you for watching this video. If you like this content, please like, subscribe, and also share my channel, that is the Finance Guru, Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.